Well, greetings, good morning, Tony Virtue speaking, and welcome to our monthly newsletter. As mentioned, I've been able to travel around the world in July, which is a great thing to do. Asia and then over to London, Boston, a few days at Harvard, San Francisco and home. So great to see some of the clients overseas as well. One of the things that becomes very, very apparent as you travel is some of the global themes that really are permeating right throughout the world that we live in. And technology obviously at the center of that. So you look at businesses in Silicon Valley now, the Googles, the Apples, dare I say the Ubers, the Airbnbs, and the world has certainly changed, and as investors we need to adapt to that as well. But the general principle being that life is getting easier via technology. We're all benefiting from that, but we also need to adapt our business models to understand that we're living in a very consumer-friendly world now. Australia only has 2% of the world equity markets, and so it's particularly important that we diversify overseas, particularly in the area of IT, areas of healthcare, for instance, where we're relatively small in our economies. So generally, I thought a pretty upbeat story there. Probably the most interesting area at the moment is China, and many of you would have read how the Shanghai index had fallen 30%. You may not have been aware that it actually doubled over the preceding 12 months. So just common sense says that if an economy is growing at 7%, and I doubt that is the case, for the stock market to double, that really does not make sense. So expect all kinds of markets to revert to the mean over time, and it's still up 70%. The Chinese government naturally are doing what they can in their own way to if I can say, manage the situation. So tightening up on margin lending, quite a few companies at the moment taken off the bourse. If you're a larger shareholder at the moment, you can't trade the company. And quite a difference between stock that's listed in Shanghai and the equivalent in Hong Kong there. So moving parts with this, it's going to take some time. In general, we're investing more in Hong Kong so that we've got some level of confidence that the markets are actually what they say they are. Overnight, the Chinese market did again jump, and common sense says when you've got 1.5 billion people over there coming into middle class in general, that you will see some growth in their share market over time. If I compare the Chinese price-earnings ratios with other countries, still relatively low. So the equivalent companies in America might be twice as expensive there. So I don't think you need to be too rattled by that, and only a small part of our portfolios. Getting back to our local markets, the Sydney property prices still continue to grow. We must be getting closer to the top now. I think the leading indicators are saying that at some stage there has to be a limit based on the rent that you can get from a property. There are international investors still coming in that are kicking that along. One of the positives out of this is, and we're seeing this with the client base, a number of empty nesters who now are selling their homes. Their properties have gone up significantly in value over the last couple of years. They're trading down, they're taking the difference in the proceeds, they're reinvesting back into income streams, and that is helping them in their retirement planning there. So look, it's a fairly steady story out there. We're coming in now to earnings seasons in Australia, so a lot of the year-end results coming out. These are reasonably predictable. We do have continuous disclosure, so there shouldn't be too many moving parts. You can see the banks raising capital at the moment, so a little bit volatile. But again, I think longer term, that's a good thing to have more capital rather than less. So look, that's enough for this month. I'll look forward to seeing you next month, and good investing. Thank you.